Well, good afternoon. Nice to see a pretty good full house. Over the next 15-20 minutes, some highlights on our financial performance for 2016. Excuse me, as you guys well know, we have a August 1st through July 31st fiscal year end. We used to be on a calendar year end way back when I got here 20 years ago, but we switched 15, 16 years ago to that July year end. So these results you're seeing today would be for the 12-month period August 1 of 15 through July 31st of 16. So as our auditor reported this morning, as you can see on this first slide, Gardner Thompson comes in every August and does our audit. They're a Des Moines-based auditor. They specialize in co-op audits. They do 100 plus cooperative audits in the Midwest, a couple out in California, so we're not their only rodeo. These guys know what they're doing. They have a 50 plus year experienced history of doing co-op audits, and so they're very well versed on cooperatives, which is why we have them here, and they're a good asset to have throughout the year for questions, etc. But basically, as a member, you can see that we had a unqualified opinion, clean audit opinion, no adjustments this year again, which is what you're looking for as a member owner, as a banker, as a supplier to the co-op. That confidence in having a clean audit opinion with no adjustments is worth a lot and says a lot about your cooperative. So again, clean audit opinion this year, no adjustments, and we're very proud of that. These guys come in early August, mid-August, real timely. We get this thing done pretty quickly, so it's efficient. It gets done in August. My staff does a good job preparing, and we get these guys in and out of here pretty quickly. So again, clean audit. And real proud of that. It was approved this morning by the delegates, which is part of their governance function. And one other thing I want to point out on the slide is we post about 7 years of our audits out on our website, the full 33-page audit with notes. So we're very transparent about that. We're very open about our earnings. And if you want to go out for some nighttime reading, just go out on the website, and you'll find seven years out there with full details. So we're happy to do that. I don't know if everybody does that. Sometimes when I go out and look for others, I don't find that availability, but you'll find ours out there, and you have for years. So feel free to go out and take a look. They're all out there for your reading. I'm going to go through some of the financial numbers here from this year and last year. You can see in that first box. Just to kind of give you a flavor of how we got to where we were in terms of our profitability this year compared to last. If you look at last year in the right-hand column of that first box, 2015, obviously Dale and Hal spoke to it. It was a record year. The sun, the stars, the moon aligned on the grain side of our business. And your co-op was in a position to take advantage of it. And I mentioned that this morning because I think it's worth mentioning. Things don't typically happen by accident. I don't know that all others in our area were able to capture the profitability we did a year ago. We're proud of that, and certainly we're happy to have that profitability hitting the balance sheet a year ago, leading into the downturn, the lower margins that were in place in 2016. So did a good job taking advantage of things last year, had a record year, 28 million local, 40 million net savings. Obviously, on the left-hand side of that column, you heard Dale and Hal both talk about lower margins, especially on the grain side of the business this year, which resulted in about $500,000 local income, albeit, a small profit, a profit nonetheless, and a $6.6 million net savings. So at the end of the day, your cooperative was profitable. It handled similar grain volumes, similar fertilizer volumes, but the margins just weren't there due to price reductions on the grain side, hence the smaller savings, but positive savings nonetheless. I think that bears mentioning here. What are positive savings? What does that mean? When you go down to that second box, $6.6 million of earnings, positive earnings, certainly helps meet or exceed all of our bank covenants, which you can see in the bottom box. We had an $83 million working capital level at the end of July on a $60 million bank covenant. So when you do the math, we were about 40% higher than our bank required us to be at the end of the fiscal year. Again, we all know banks are conservative. We understand why they are. So to exceed their conservative covenants by 40%, we were pretty happy, even in the challenged margin environment that we had in 2016. If you look at the equity in the company at $248 million at the end of July on a $198 million covenant, again about 25% over bank covenant. Happy to be in excess of covenant again. The bank likes to see that. We like to have that cushion. And so your balance sheet is well positioned from an equity and a working capital perspective leading into this lower margin environment that we're going into. If you look at the last covenant at the bottom of the second box there on local leverage, every entity has some covenant relative to leverage, right? How highly leveraged is your balance sheet? Ours with CoBank on a local leverage perspective says we need to be below 100%. And you can see we're at 71% as of the end of July. I will tell you we're at 68% today at the end of December. So we've moved that down even further, about 3 points in the last 5 months, which is good. And so what does that say? What does that give us the ability to do? Your cooperative has the ability, with that type of position balance sheet, to take advantage of an opportunity should it arise. There's no big capital expenditure projects on the drawing board right now. But if something would present itself from a CapEx perspective that made sense, or any other opportunity that could come about, with these cushions on your covenants on your balance sheet, your co-op has the ability to react and take advantage of that if the board deems it appropriate. So I would rather be in this position than not. I think it's a good position to be in. As you can see to the right, in 2 short years, we actually delever this balance sheet from 71% leverage to 27% leverage. The reason that happens is your term debt is structured at about 7 years. So like I told the group this morning, there's no 30-year mortgages on any of this term debt that we've used to build out your facilities, which I'll show you in a minute. It's all on about a 7-year term. So, we quickly delever down to almost net nothing in a couple of years with normal earnings here. Which gives us, even further bandwidth to do more things if they come about. So a lot of times you hear people talk about we have a strong balance sheet, and we do. And you hear that in the industry. What is a strong balance sheet? When I look at a balance sheet, I look at liquidity, the working capital, the equity, the leverage, the three you see on the screen. A couple other things you look at is how the term debt is structured. Is it evenly structured to be paid off over 7 years or 27 years? I think that's another thing you have to be aware of. And again, ours is on the lower end of that at 7 years. The other thing you look at when you see a balance sheet is the relative newness of the fixed assets. If you look at this next slide, I put this together just to give you guys as members a little bit of a snapshot as to the relative newness of the fixed assets that your co-op has put in place to service you, and how well positioned this co-op is going into this downturn to service you without having to spend a bunch of money, quite frankly. If you look at the top 2 lines on that thing, the 1 to 7 and the 8 to 10-year-old line items comprise about 87% of the assets that you have on your balance sheet. So in the red circle, you'll see $500 million of assets. That's $500 million of strategically placed newer assets this co-op has put in place during a low-interest environment and a very good ag economy to position the co-op, quite frankly, very well for the future. Again, not sure everyone could put that slide up and tout that type of an asset base to be in position to service you. So glad they're there. Glad we built them when we did. If you look at the top 2 initiatives, you guys remember the Connecting to Tomorrow initiative back in 10 and 11. That was a $100 million drain build-out. And then the last few years, we did the Dakota Lakes financing with Land O'Lakes, that LLC that built out about $40 million of agronomy assets. So glad we did it when we did. Rates were low, economy was good, and we've got the assets in place to serve you, well positioned. If you look at the markers on the right-hand side of the slide, these are new assets. They're efficient. They're strategic. They've got the ability to handle additional capacity without having to add a bunch of upgrades or pour money into them. They're high quality. Reputable contractors that stand behind their work. And we basically, entirely rebuilt our system and well-positioned the co-op for the future. So feel good about that. Feel good about where we're at on assets. On the expense side, I think you've heard both Dale and Hal talk about expense reductions. If you look back in 2015, the audited numbers on the left-hand side of that chart, $147 million of total co-op expenses. Our audited 2016 numbers were $138 million, so down about $9 million to Hal and Dale's points earlier. And then you can see the budgeted amount for 2017 is about $132 million, for a total expense reduction over the 2-year period of $15 million and change in that right-hand column. It's about 10% of our expenses we've taken out of this thing, or will, over a 2-year period. Not unlike what you guys are doing. We have to react, we have to be proactive, and we are. We're taking costs out where we can and still wanting to service you with the excellent service you've become accustomed to. So about 10% of the expenses are coming out of this thing over a 2-year period. And I think Dale touched on it earlier, you know, through December, I think we're about $4 million down on expenses through 5 months of our fiscal year already. So well on our way to that second tranche of $6 million expense reductions this year through 5 months. At the bottom of the slide, you can see the discretionary expenses. I've got them listed there. Account for about $3 million out of the $15 million over 2 years. It's about 20% of that $15 million. You know, those are things like advertising, meetings, you know, public relations, contributions, dues, things you can kind of put to the side or at least curtail for a year or two. And those amount to about almost $3 million over 2 years we're taking out of the system. So doing everything we can. Everything I hear from our banker when I talk to CoBank, I'll be honest with you, they're very complimentary. I talk to other co-ops in Iowa and Nebraska, to their CFOs. Everyone I talk to says you guys are probably doing more than most anyone we've heard of to be proactive about this. Not that others are not doing anything, but safe to say your co-op is trying to be on the leading edge of that. Next slide I've got here is just to give you an update on our financing and our capital structure. Again, feel like we're well positioned here. If you remember, some of you last year or a couple years ago, we got into a 3-year bank deal with CoBank, which went from March of 2015 to March of 2018. We were able to renegotiate that deal in July this year when we exited the Dakota Lakes Financing LLC, and I'll talk about that in a minute. But as part of that renegotiation, we extended our bank deal another year out to March of 2019. Same 19 banks, CoBank as a lead bank, 18 Farm Credit System banks and 1 private. We keep 1 private in there just to kind of get some intel and hear what everybody in the private bank market is doing. So at the end of the day, we're not sitting still. We're not sitting on our hands and saying we had a 3-year bank deal. Well, now we have what in essence was a 4-year bank deal. And what does that do? That locks in your rates, that locks in your rate grid, that locks in your fees, it locks in the committed 19 banks to fund your seasonal line. And so we're pretty happy to get that 1-year extension to kind of help us navigate through the next couple of years. Again, CoBank with the lead, 19 total. You can see we've got access to a $400 million operating line. That's structured in several tranches. There's a $250 million immediate line. There's a $50 million bulge line available Jan through May. And there's another $100 million accordion line that sits on top of that. That's committed should we need it. So all totaled $400 million. Our peak borrowing this year, as we hold some more grain and bushels that came in this fall, has been around $100 million. So very comforting in a year when we're needing the line. We've got the availability almost fourfold to where we've hit a peak right now. What does that allow us to do? You know, it allows us to buy crop and grain inputs, buy your grain when you want to sell it, take advantage of volume discounts from suppliers, hold hedges, grain positions, you know, all the things we need to do. We just paid $157 million of deferred grain contract checks in the last week in this company. And I think that just goes off without a hiccup every year, as it should. So we're very proud of that. Having access to this line, you know, gives us the ability to do that. And lastly, on the slide I mentioned on the right, some of you remember we got into a 50-50 financing LLC with Land O'Lakes. Several years ago, we leveraged that strategic partner for some financing. It built $40 million of agronomy assets for your cooperative. We had a 3-year exit clause built in, early exit clause. We exercised it immediately after 3 years and got out here in July. So those assets have been put on our balance sheet. CoBank financed the buyout. The LLC has been dissolved, and that LLC is history at this point. So served its purpose. We got in, we got out, we got it done. Land O'Lakes carried the heavy water on the legal side of that, saved us a ton of money. So, if there's any message here, and I think Dale and Hal have probably mentioned it earlier, so, your co-op does a good job, I think, leveraging the strategic relationships with these strategic partners, CoBank, Land O'Lakes, to put financing in place for you, to put financing LLCs together to build you stuff. I think we do a pretty good job trying to do that for our member owners. On the patronage side, just a couple slides here. With limited earnings this year, positive earnings, but limited nonetheless, the board's disposition this year was, they kind of asked me, well, how do we put the most cash in our members' hands with the least tax liability? How do you do that with positive yet limited earnings? So a couple of decisions they made. If you look at the first bullet point, qualified patronage allocation, they decided not to do one. Reason being, it's typically paid out of local earnings. We don't allocate the paper we get from regional co-ops like Land O'Lakes and CHS. We allocate our local earnings, which is earnings from our 40 locations operations. With $500,000 of local earnings, positive, yet not really enough with 5,400 active members to go through the administrative cost of sending out $100 allocations and $40 checks. So again, we'll get to it on the next slide, but what the board kind of asked is, well, how do we put the most money in their pockets with the least tax liability given the limited earnings we had this year? Second decision we made around that was to not do a non-qualified allocation. Again, no cash changes hands in the year you allocate that, only in the year you pay it. So we decided to forego the first two allocations. And on the next slide, you can see what the board voted to do was to pay out another year of old year equity and put $2 million of old year equity cash into the hands of our members tax-free. So what that did is kept us at a 16-year revolvement, which is where we were the year before. We added a year and paid off a year. So right now we're revolved through year 2000. We've got 01 through 16 inclusive there, 16 years left on the books. So that put $2 million cash into our member owners' hands. Some of you may remember, this co-op used to pay 30% cash on their patronage dividends, and we've moved that to 40% cash several years ago, 4 or 5 years ago. Having done that, our average equity payout the next 4 or 5 years to keep us on that 16-year revolvement is a couple $1 million, give or take. So I think, again, we've positioned the equity revolvement very manageable to keep you at that 16-year revolvement. Now, don't video it and hold me to that, but I think we've got that thing positioned to a couple $1 million a year to keep it revolving a year every fall. So they voted to pay out the equity, and if you look on the right-hand side of the slide, the other programs we have, sometimes I think they get a little bit forgotten, but they're very important. We do have an age 70 program, which pays all your equity out between age 70 and 80. That was another almost $600,000 a year to patrons. Our age 80 program is about 2 years new. That says at age 80 you get all your equity out of the company no matter what you have, 100%. That was another $250,000. In our states were another short $250,000. All totaled about $3.1 million of cash into our patrons' hands this year. Most of that, a lot of that being tax-free. And in the last part of this slide, I wanted to make mention of a concerted effort we began a couple years ago when we hired Mike Traxinger as our in-house corporate attorney. One of the things Mike's done a good job on is put us on a path to be compliant in all 50 states with unclaimed property laws, which is not an easy thing to do, I will tell you. We've got a goal, and we will be compliant in all 50 states by June of 2017, which is about 6 months away. And Mike's been working his butt off on this. But basically what that says is if somebody were to call you today and ask you as a director or an owner or a board member of this co-op, hey, how are you guys doing in regards to unclaimed property? You would be able to give the same answer that we got when we called CHS, Land O'Lakes, Growmark, and some of these other big cooperatives, legal departments, and we asked them, what's your stance on unclaimed property? The answer you get is, we're compliant in all 50 states. And so we're well on our way down that path. In about 6 months we'll be there. And again, it's due to the fact that you've got an in-house attorney that gives you the ability to do this. What does that mean? It's just an effort to get the cash in the rightful hands of the owners, as you can see on the slide. If somebody hasn't cashed a check and we reissue it and they don't cash that one again, and it's outstanding for a certain amount of time, it hits an unclaimed property list. This process in all 50 states gets that money out to the owners that it rightfully belongs to. And to date, we've sent checks out totaling about $400,000 thus far. We continue to get applications monthly. We just did a monthly process of these checks again today, quite frankly. My staff is doing that. And we do have a list on our website that's out there all the time. If you think that you might have some, go out and look. If your name's on it, give us a call and we'll get you the check. So really proud of that. Mike's really kind of led that, but very happy to be able to stand up here, as your CFO and tell you that we're doing that. I question whether everyone is putting the effort into that your co-op is, and we're proud that we are. So between those two initiatives, again, in an effort to get cash in your hands this year with limited tax liability, there's about $3.5 million. As we get to my second to last slide here, the other thing I wanted to touch on was this DPAD Section 199 deduction, domestic production activities deduction. You guys are very familiar with it. It's captured at the cooperative level annually, and then the board determines whether they pass the deduction through to the grain customers or do we keep it for the co-op. Wherever the best tax dollars are saved is where that deduction stays or goes, is basically the board's disposition. And so when you look at it, 6 out of the last 7 years, we've passed that through to our member owners. The right-hand column will tell you that's a $100 million pass-through of tax deductions, 6 out of the last 7 years in total, in aggregate. At a 25% marginal tax rate, that's $25 million cash, I always like to say, stays in eastern South Dakota and southeastern North Dakota versus going somewhere else. We can spend that here. So that's a hell of a deduction. I think it bears mentioning. And it amounts to about an 11 cents a bushel allocation annually, which if you apply a 25% tax bracket to, or tax rate to, it's about 3 cents a bushel. So when you're out there looking and you're hearing and you're looking at grain bids, remember there's about a 3 cent per bushel benefit out of this tax deduction and another 2 or 3 cents on your patronage. There's another 5-6 cents out there of value your co-op brings you in terms of these tax deductions and equity revolvements and pass-throughs. When you're comparing bids, make sure you don't forget that. The left-hand side I think I skipped, but basically this was a record year for pass-through. It was somewhere between $21 and $22 million, again, that we sent to our patrons this year alone, which saved them admittedly somewhere in the $5 to $5.5 million range. When you add up the slide before, there was about $3.5 million on this slide. There's about $5.5 million on the current year left-hand side of this slide. Again, assuming a 25% bracket. There's $9 million of cash your board got back to you by still prudently managing the equity of the co-op, but still getting $9 million of cash back to its member owners through these patronage programs. I think that's all I had. Thank you.